Good morning. This is Neil, your trusted mortgage agent. I hope you enjoyed the last long weekend of summer. It always goes by fast, doesn't it? But don't worry, I've got some exciting updates to brighten things up. The Bank of Canada just made another move with interest rates, and I'm here to break it down for you. Let's dive in. This morning at 9:45 a.m., the Bank of Canada made another move, trimming the policy rate by a much anticipated 0.25%, taking the policy rate from 4.50% to 4.25%. Now, that's a third rate cut in as many meetings, nudging the prime rate down to 6.45%. Now, what does it mean for you? If you got a variable rate mortgage or loan, you will see your monthly interest costs drop by about $20.83 for every $100,000 of mortgage or debt you're carrying. Since June, that's a cumulative saving about $62.50, again, for every $100,000 of debt. But here's the kicker. Variable rate mortgages aren't doing you any favors when it comes to qualifying for a mortgage. If you're in the market for a new home or considering refinancing and want to maximize the amount you qualify for, you might be limited to a 5-year or at best a 3-year fixed rate option. So, why did Bank of Canada decide to cut rates again? Well, there are a few things going on. For starters, the policy rate is still higher than the 20-year pre-pandemic average, which was about 4.62%. We have also seen Consumer Price Index or CPI gradually easing. July's rate was down to 2.5% from May's, which was at 2.9%. GDP growth, not much to speak of, with zero growth reported for June and the same anticipated for July. And job growth is also slowing down, with unemployment rate ticking up to 6.4% and the employment rate falling to 60.9%. All signs point to more rate cuts on the horizon. If this trend continues, we could see the prime rate drop by another 0.50% by the end of 2024, maybe even dipping below 6% before the new year. But enough with the big picture. Let's talk about what this means for your mortgage situation. First, the gap between bond yields and fixed rate mortgages is shrinking, but it is still much higher than the average. As demand for mortgages pick up, this should lead to more competitive fixed prices. Even though variable rate mortgages are still pricier than fixed rates, that gap is getting smaller. With today's rate cut, we are looking at a spread of say 0.85% to 1.1%, and so there is definitely more room to cut. Those of you considering a variable rate mortgage, you're essentially betting that the prime rate will drop by another 1.50% within the next 15 months to make it worth your while compared to locking into a currently available 3-year fixed rate. So the question is, what should you be doing? Let me break it down for you. Firstly, consider a 3-year fixed rate mortgage if your current variable rate is giving you a hard time with those monthly payments. Switching to a 3-year fixed rate could provide much needed relief, and those rates are pretty attractive right now. How about evaluating a 5-year variable rate mortgage? So, if you got some wiggle room in your budget, then a variable rate mortgage might save you more over the next few years. But watch out for that gap with a 3-year fixed rate. If the spread is too much, then I would suggest going with a fixed 3-year. What if you have a renewal coming up? So, if you have a renewal, a 3-year fixed rate could help you avoid the higher payments associated with the variable rate mortgage if that is a big concern. It should give you the flexibility to also secure a lower rate sooner as you're only locked in for a shorter duration. Now, what should you consider if you're locking yourself into a fixed rate mortgage? Well, make sure you're comfortable with the terms. If the rates drop significantly, getting out early could be very costly. And what if you're currently in a fixed rate mortgage? If you're in a fixed rate mortgage and your rate is above 5%, and you've got still maybe 2.5 years or longer left on your term, then this is a good time to evaluate your options. Waiting any longer could make switching prohibitively expensive, and there could be quite a bit of interest savings available if the timing works out for you. Of course, these are general recommendations. For advice tailored to your situation, give me a call. I'm always here to help. And that's it for today's update. For more detailed insights and charts, check out our latest blog. There's a link in the description. And as always, if you have any questions or need personalized advice, don't hesitate to reach out. Thanks for watching, and I will catch you in our next update on 23rd October. See you.